Hi everybody, welcome to my channel. Today we are going to see one of the most common ways of trading in the stock market, which is options trading. And specifically in this episode, we will be simplifying and learning the most common type of options trading, that is buying options. So without further ado, let's go to the charts. Alright, here we're going to be talking about buying options. And what are the two types of options? Call and put. Now when you are buying a call, alright, your basic assumption is that the market is going to go upwards. Okay, it's going to be a bullish trend in the market. Okay, so the market is going to be making higher highs and higher lows. And what's the basic investment principle here? That you buy low and you sell high. Alright, remember this. You only enter the market to buy a call option if you think the market is going to go upwards. Alright, and your investment principle is that you buy low and you sell high. Alright, okay. Here I have taken an example of Nifty index. Okay. Now for the sake of example, I have chosen 17,450 as our strike price. And what is the strike price? It is nothing but the price at which we buy or sell our option. 110 is a premium. It's same as the booking amount. So to the strike price, we are paying a premium of 110. Okay, and as I said, we are entering the market intending to buy a call option, then we should be having a bullish trend. So we should be expecting the Nifty index to rise higher. So for the sake of example, our target is 17,750. Okay, also called as the spot price. So we are assuming that the market is going to rise from 450 to 750. For the sake of example, we have chosen a weekly expiry. What does it mean? Suppose we take this call option on a Friday or a Monday, then we have till the coming Thursday to buy this or to sell this, okay, or to square it off. So our strike price is 17,450 and the premium we have paid is 110. Now our profit target. Now this is something very critical, very important. Many people make a mistake. Now what is our profit target and what does it mean? We add the strike price with the premium, and in our example it comes to 17,560. So what is this profit target? You will only start making profit, you will be in profit in your call buying when the market rises above 560, not 450. Okay, many people make this mistake. They start calculating their profit from 450, but they forget to factor in the premium they have paid for it. Right, it's already gone from your pocket, right? You have already paid your premium. Okay, so you have to add this. All right, so now we understood that our profit target is 17,560. That means only when the index starts going above 560 we will be in profit. Okay, now let's look at some profit and loss scenarios. Our target price was 750. Our strike price was 17,450 and the premium we paid was 110. You can by heart this formula. Okay, so target price or spot price minus the strike price minus the premium, it gives us a value of 190, a positive 190. So we have made a profit of 190. All right. Okay, now let's look at another scenario. Our target price is 17,550. So instead of waiting for the market to go up 750, for some reason we decide to sell it earlier, and that earlier point I have taken for the sake of example as 17,550, and our strike price was 450. It doesn't change, and our premium is 110, and as per the calculation the value is -10. That means we made a loss. Remember, 17,560 is our profit target. We only start making profit when the Nifty will start going above 560, 17,560. But here for some reason we decided to sell it at 550, which is lesser than 560, and that is the reason we made a loss. Okay, remember this. Okay, the third scenario, the target price, instead of going upwards, it goes downwards. Okay, so here suppose our stock price was 450, but the market goes downwards to 400. Okay, minus the premium, and the value which we get for target price or spot price minus the strike price is a negative. Okay, and this value, target price minus the strike price, is called as the intrinsic value, which cannot be negative. Remember this. Okay, commit to your memory that the intrinsic value, which is the target price minus the strike price, cannot be negative. So it is null and void, and you lose your premium. Okay, so this is one of the advantage in buying options, be it call or be it put. The potential to make profit in buying call options or put options is unlimited. Okay, but when it comes to loss, the loss is only limited to the premium you have paid. That is the reason most of the investors are into options buying, because the capital is less as compared to option selling, which we will see in other episode. Okay, so remember this thing. The potential to make profit in buying options is unlimited, alright, but the loss is limited to the premium you have paid. Alright, okay. Now let's take the example of buying a put option. Okay, it is exactly the opposite. Now when would you enter the market if your intention is to buy a put? When the sentiments are bearish. Okay, you know the market is going to fall down, it's going to make lower highs or lower lows. Okay, and what is the investment principle in such a market? You sell high, you buy low. Commit this to your memory. Whenever there is a bearish sentiment and you wish to be a buyer of a put, you sell high, you buy low. Alright, once again we have taken the example of Nifty index. Now for the sake of example, I have taken 17,350 as our strike price. What is the strike price? Nothing but the price at which we buy and sell. Alright, and the premium you are paying is 110. So here it is. Since our assumption is the market is going to go down, we have chosen a target of 17,100. Okay, so we are assuming the market will plunge or will go down from 350 to 17,100. Okay, for the sake of example, we have chosen a weekly expiry. Alright, our strike price is 17,350 and the premium which we are paying is 110. Alright, once again, this is very critical. Don't make a mistake. Our profit target is 17,350 minus 110. The result in our example is 17,240, which means we will be in profit only when the Nifty starts going down from 17,240 onwards, not from 17,350. Alright, because you are paying a premium. Alright, it has gone down, it has gone from your pocket. Okay, so we will be in profit only when Nifty starts falling below 17,240. Okay, remember this. Alright, always remember to factor in the premium. Okay, now let's see some profit and loss scenario. In our case, we took a strike price of 17,350 and our target price was 17,100 and we paid a premium of 110 and we get a positive value of 140. So we made a profit of 140. Okay, pretty clear, pretty simple, pretty straightforward. Alright, now the second scenario is the strike price is 350. Alright, remember it never changes, but for some reason we decide to change our target price from 17,100 to 17,250 and we minus the premium and we get a value of minus 10. Okay, now why do we get a value of minus 10? Why are we making a profit of a minus 10? Because our profit target was that we will only be in profit if the Nifty goes below 17,240, but we ended up selling at a higher strike price than 240, which was 17,250. Okay, so remember, always remember to factor in the premium. That is the reason we made a loss of 10. Alright, now once again there is a strike price of 17,350. Remember, the strike price never changes, and what happens here, instead of going downwards, the market moves upwards to say 17,400, and the strike price minus target price is nothing but the intrinsic value. And as we saw in buying a call option example, intrinsic value cannot be negative, so this 17,350 minus 17,400 gives us a negative value. Since the intrinsic value cannot be negative, it is null and void. You end up losing only your premium, which is 110. Okay, as explained and discussed in buying call option, the only amount you lose is your premium you have paid. So similar is the case as was in buying a call option, that the potential to make profit is unlimited and the loss is limited to your premium. Alright, remember that. Alright, now some pointers. The strike price, the price at which we buy or sell an option, is always constant. Okay, it cannot change. Intrinsic value, we saw, it changes, right? Because we can change our target. Alright, alright. Premium also changes by the second in the market. Okay, and there is something called a time decay, which is the enemy of premium for buyers. Okay, as the time decays, as it nears the expiration date, the value of your premium of the call or put which you have bought starts decreasing, starts decaying. Alright, so does your profit if you're in profit. Okay, so remember, always factor in the time decay. This will help you in ensuring a good profit or lessening your loss. Okay, alright. Now, last but not the least, remember, always factor in the trading platform charges and the government tax, okay, to get an accurate idea about your profit and loss statement. Okay, alright. Now let's see some scenarios. This is something very basic. Okay, so you get an idea when it comes to options buying versus selling. The buyer of a call option makes profit in 1 out of 3 situations. And what are those situations? If the market goes or favors his view, which is bullish, and the market does go bullish, it does go upwards, he makes a profit. But if the market makes a sideways movement, he's going to make a loss. Alright, and if the market goes against his view, it goes bearish, he's going to make a loss. Alright, and in put option is the opposite. Alright, in the sense, he wants the market to go downwards. He has a bearish view, and if it does favor his view, he's going to make a profit. But if it goes sideways, he's going to make a loss, and if it goes against his view, that means it goes upwards, he's going to make a loss. Okay, he's going to lose his premium. Okay, so this graph represents that the number of times an option buyer makes profit. That is 1 out of 3 such scenarios an option buyer will make profit. Okay, so remember this thing. An option buyer, 1 out of 3 times he's going to make profit, but the other 2/3 of the situation, he is not going to make money. He will be losing his money. He will be losing his premium. Okay, I hope you have understood this. See you in the next episode. Thank you for listening. Bye bye.